hi, good to see you.
Hey Lisa, how are you?
I'm doing well. Thanks for joining me today. I really appreciate it.
Thank you.
Before we start, I just want to introduce you to my audience. Everybody, this is Steve Edding, the CIO and founder of Anchor Pacific Investment Management Group. I'm going to have Steve, if you could just talk to everybody about your company and what you're doing and how you're dealing with this, sheltered in place situation right now, that would be great. Start there.
Great. Thanks for having me. And yeah, I'm here in my living room in my home in Vancouver, British Columbia, in Canada. And as you mentioned, I'm the founder and CIO of a wealth management firm. Would be the broadest sense of what we are. And I've been in Vancouver since 2010, late 2010, having worked for about 15 years on Wall Street, three different firms, the last of which had been Deutsche Bank in Asia. And we planted a flag here in Vancouver and founded the company in 2011 as we weren't sure where we were going to go at that point in time. It was just myself, and so we started out on kind of the R&D side with alternative investments, knowing that we wanted to build some intellectual property around the area of alternative investments, and mainly in the public realm of hedge funds. And in 2016, we decided that we wanted to take it a little bit further and become a registrant. So we are a registered portfolio manager. Securities Commission, provincial securities commissions govern that landscape in Canada, and we serve investors through the building of multi-asset programs that heavily use alternative investments as a foundational differentiator. But not as a traditional kind of wealth advisor, but more as an outsourced CIO, where the centralized investment office governs all investment decisions, and then it's serving a variety of high net worth clients, family offices, other financial advisors that don't have the portfolio management capabilities. And some of the lower levels of the institutional spectrum.
So let me ask you this. First of all, Vancouver, I love Vancouver. It's like, I think it's my favorite city in North America. As you know, we talked about this. I lived in Vancouver on and off for 7 years, kind of 6 months there, 6 months in Florida. My husband's from Vancouver and love it so much. So lucky you for being in Vancouver. But I'm wondering, I'm just curious.
It's been interesting and it's been fun.
Yeah. You're American, living in Vancouver, and how does it work? Are you able to invest into U.S. hedge funds? Are there any issues with that, being Canadian?
It depends. It's all investor specific. Most of our investors are Canadian taxpayers, so you do have to, so Canadian access product, domiciled product is obviously the easiest to invest in, but we can invest in, really in any asset class in any jurisdiction, provided the risk reward, proposition is compelling enough, and we certainly look at hedge fund managers in particular globally.
Yeah, excellent. So with this pandemic that we're all experiencing and this new world order, the volatility in the market, just curious, what are you seeing and what are your thoughts on what's happening right now? And are you able to take advantage of any opportunities that are presenting themselves?
Well, we're certainly starting to think about how we are going to go about this next period in this phase where, frankly, we just don't know where and how long things are going to take to normalize, and it's not really for us to guess. But the speed of the decline was quite like it was steep, right? And that's what everyone is saying. And it almost kind of took everyone by surprise. And you had a phenomena of a Main Street event that then moved over into, to Main Street to Wall Street versus, 2008, where it was really the other way around. And so the narrative has changed, quite a bit. And we've had a lot of communications. At first it was with clients right away to be proactive and out in front. And then it was with prospects, that weren't, clients yet. But it was seen as an opportunity once again to get in and explain what was happening. And what we found was these communications were happening frequently, but the information was changing on a daily basis. So 2-3 days later, we weren't necessarily saying the same thing, because as you get more information, things were changing. And while that was all being said and done, we were also assessing our existing portfolio, and particularly our managers that we pay to do various things for us, and really trying to get an assessment as to what was actually happening at the portfolio level, what was happening at the manager level, and they were also upping their communications as well, some more than others. And so we've had to really try to get a sense right now on the manager side of things, which I think is probably most revealing to this audience, as to, which ones may be struggling, which ones are doing exactly what they need to be doing, and then which ones are, is more interestingly, going to be in position to, to take advantage of some really interesting opportunities as a result of some of the distressed selling that we've seen.
So when you look at the market as a whole, I mean, you're obviously talking to a lot of managers, and you have a lot of insight into what's going on. And just wondering, what sector are you more bullish on than others?
Yeah, sure. I mean, we, so our portfolios, for multi-asset accounts, where we're managing substantially all of their assets in the form of of an OCIO type program, are generally 35% passive, and that's usually just liquid growth, equity market beta, and they're 65% active, more or less. I mean, it could be 60, 70, and so we haven't been in love with equities for a long time, but the cost of not being in equities has been challenging. And so we didn't love equities at S&P, just under 3,400, and we don't really like them now either. At, I think we closed around 2,500 today, because we just think there's more downside there, and we believe that the credit markets are always a precursor to the equity markets, and so this leverage unwinding is something that it was quite severe. It was fast, and but we only think it wasn't just a one-time thing. We think there will be more leverage that needs to be unwound, and it's going to manifest itself in different ways and in different parts of the credit markets. And I use the term credit markets quite broadly, but when we look at the repricing in just more or less short investment grade corporate credit, all the way down to the more arcane segments of the securitized products market, where I have 15 years of background, and you do as well. From back probably around the same time we got started. So I see a lot of it's not quite buying debt at the prices of equity, but you're starting to now see real return profiles, looking forward, being a lot more interesting relative to equities, which, I think 2,000 and below on the S&P 500 is still quite realistic. So at the margin where, if you're looking to protect capital and buy with a margin of safety, to me, that lends itself to, various aspects of the credit market and determining where the good assets have been sold off too cheaply, right? And being able to differentiate, what good assets have had to be sold versus, maybe the less appealing assets, which, and just differentiating where the value is going to be because the sell-off has been pretty non-discriminatory.
Yeah. In other words, like across the board, right?
Yeah, without any real regard. It's there was a huge, I think it was the second week in March, right, where even the non-correlated asset classes started to have positive correlations to the equity market because everyone, the only haven was the U.S. dollar, and you had corporations and everyone needing to raise cash and just selling anything that they could, particularly short end stuff. That wasn't going to take too big a mark, but really gapped out yields in particular.
So it's like back in 2008 when we had the great financial crisis, everything ended up being correlated. We saw that happen. People just needed to raise money, so everything just became correlated. Similarly is happening now, but this is still very different from 2008 because of what's caused this market, turmoil. It's not a systematic problem like it was back in 2008, and so it's quite different. Are you thinking when you look into the future of where this market can go, since it is such a different dynamic of what's causing this market turmoil? Do you have any thoughts on maybe how it's going to look as we come out of it or don't come out of it, or the way that investors maybe react, going forward in terms of how they look at the market and how they make their investment decisions?
Yeah, that's a challenging one because, I think initially the things that people say to make themselves feel better when you have such a large movement in asset prices, particularly negatively, that this soon shall pass, or don't make a second mistake by crystallizing a loss and in other words, buying high and selling low. But the reality is that this is something that none of us has ever experienced before, and we don't necessarily know what the economy is going to look like on the other side of things. No one really can quantify what the demand side for consumption and for things that the service industry is producing are going to look like when this does, settle. And I think, I've only kind of heard the high level parts of the presentation, but Jeff Gunlick of Double Line was saying recently that he gave an example. His presentation was called Two Sinks, where he had two sinks in his house, and he never used the second sink until the first sink got a leak. And then when he started using the second sink, he actually liked it. He doesn't use the first sink anymore. And he was saying that people's patterns and their habits are going to change as a result of this, out of working from home and so things are going to change, and he thinks that's going to have a real impact on the economy that I don't think anyone can really quantify right now. So when we translate that to investment, one of the things that we have to think about, particularly if the end client is an individual or a family, is did this pandemic and did the result on their net worth, did that change their investment horizon? Did that change their need for liquidity? And so if if the answer to that is yes, and they've needed to become more risk averse or more cashed up from a liquidity perspective, then they're going to need to sell equities because they're not necessarily going to be able to tolerate another 30% more downside.
Yeah.
And I'm not saying that we are going to go there because we don't make those predictions, but we do try to deal in probabilities. And my thought is it's going to be a lot harder for the market to retest its highs than to retest its lows, meaning sitting kind of right in the middle between 2,000 and 3,000 on the S&P 500. I would play the under over the over that we looked at 2,000 before 3,000. And so that being said, the choices are going to be, are you going to sit in cash and miss, opportunities, or are you going to look for things to do that don't have equity market risk? And I think that's where we and many others are starting to see something fairly interesting, because I do believe the way credit is priced and the way we think it may be priced if it does get a little bit cheaper is that it will be pretty protected even if equities take another steep descent from here.
But one of the things that just struck me when you were talking about Gunlock's two sinks, right, is, and I said this I was on I did an interview with Andrew Gitlin the other day from PAMCO Launchpad, and this idea that, well, look, if we're in this sheltered in place situation for 30 days, 60 days, there becomes a point at which people become accustomed to behaving a certain way. And it does usually take like 20 to 30 days, that's what they say, to get into a routine of doing something. So I do think that we could see a sea change in the way people live their lives and the way they feel like they can work. But in addition, what you just said made me think of something, which is we, at least in the United States, there's a huge percentage of individuals who don't have enough savings to last them through, a month of not having a job. Well, this situation, I think, is going to wake a lot of people up. Say, oh my gosh, I was not prepared for this personally. And I don't know what the stats are in Canada, but in the U.S. it's a big problem. So if we get through this, when we get through this, I should say, I can see people, individuals, thinking differently about how they save their money and how they have their money managed and where they put their money, because certainly people need professionals to manage their money. And I think that's going to become clear. And so I think we might see more people really taking care in the way they save their money and invest their money and turn to professionals for it. And professional money managers, I mean, there's been a big, theme for the past couple of years, at least in the hedge fund space, that investors don't want to pay the fees to have managers manage their money because they feel like, well, maybe it's too expensive. But at the end of the day, if you have a good manager who's really great at what they do, I think it does make sense to pay them to help manage the money.
We agree with that. I mean, just the latter part, there's a lot that you said there. And, we particularly when it comes to active management, we look to rationalize the fees that our clients are paying indirectly through the accessing of those managers. Mainly is the manager offering something that we need in our clients' portfolios, and then the next question would be, can we get it anywhere else? And then is it fairly priced? And so, we look at those fees as a part of it's one component of maybe 10 or 15 when it comes to making a decision. Whereas, we've had conversations with clients who will say, well, that manager's too expensive versus this manager. And that's just not the way we look at things, right? So you never want to overpay,
right?
But you should be willing to pay for things that are providing value to you.
Yeah, agreed. Well, listen, before we sign off, I would like to ask you, is there one last thing you'd like to leave our viewers with before we sign off?
Yeah, I think it stems from what you just said at the beginning of your last conversation. For the last 10 years, and we published a very simple piece, that we called Next 10, and I think it was in around June of last year, and it was coming into a new decade, and we said that the returns of the past 10 years were unlikely going to be to be rolled forward, and that was a combination of effectively zero interest rates that had really everyone indiscriminately chasing risk. We'd seen herding into private strategies that indiscriminate herding, herding into income-like product without really any thought as to what was actually providing that income and what risks you were taking on in order to get a 6, a 7, an 8% yield when interest rates were essentially nothing, right? And making those connections, and so people didn't really seem to care about risk management. They didn't seem to care about asset allocation, and now I think you're going to see, when clients start to get their statements, March 31st was 2 days ago. So when they start seeing their statements, they're going to think they've got some kind of balanced risk tolerant portfolio, and they're going to. I think they're going to be quite surprised if they take the time to unpack what it is that they actually own and how it did, and many will need some help in doing that, and they're going to need some objective help in doing that. But for anyone who moved there are 40% bonds, for anyone who moved that into bond replacements, I think a 60-40 portfolio, depending on geographically where you split those allocations, year to date is probably down 13-ish%. I would venture to say that there are going to be many 60-40 portfolios that are down 18-20% because of the risks that were taken as money was moved out of bonds. And so what I'm kind of getting at is asset allocation is really going to matter going forward, and understanding the risks, both in how managers and how investments work together, how those returns are being derived, who are going to be the winners, going forward, because there will be winners and losers when you're speaking to active management. I think it's just going to be really important, and I think an attitude and an aura of complacency where investors just think, oh, it's going to come back. It did in 2008. I just had to, I had to just stick with it. I don't believe that just sticking with it this time is going to work. I think you're going to have to make some serious adjustment. I think many of the largest institutions will not, but I think for many investors, this is a wake-up call to get informed, to get better informed about what is in your portfolio, why it did what it did, and more likely what it's likely to do going forward.
Get more engaged, actually, in what you have. Understand it better. That's what you're saying. Asset allocation becoming more important. Yeah, I agree.
Yeah, the dispersion factor is gonna, because nothing, when everything's going up, nothing matters, right? But when things are going down, or when they go sideways for a long time, which is another, very likely thing, it's going to matter, and so you are going to need to have things that are going to be able to grind out returns in a lot of different unstable environments.
Yeah, I agree. Well, I think that's a really good note to end on. I think it's actually a very positive note because it gives people, a call to action in a way of maybe how to deal and move forward as we get through this. And I want to thank you again for spending some time with me today to do this call. And, we can check back in maybe in a month or so and see how things are going and see, how things have progressed. And, I wish I was up there in Vancouver British Columbia right now instead of here in New York.
Well, it is a beautiful day, and thank you for having me. It's been great, and I would love to come back anytime.
Excellent. We'll keep in touch. Take it
Thanks,
easy,
Lisa.
stay well, be healthy. See you soon.
All right, you too.
Bye bye.
Bye bye.